Alright, let's break this down. If you're trading options and you don't know what in the money, at the money, or out of the money means, well, you're basically playing chess blindfolded with boxing glasses on. So today we're going to dive into the absolute basics, but not in that boring textbook kind of way. I want you to actually get this in your gut. Let's use something we all understand. Leasing a car. You lease a car, right? Maybe 6 months, 12 months. You get to drive it around, but at the end of the lease, that car, it goes back straight to the dealership. You don't get to keep it. Options work the exact same way. You don't actually own the stock. You're just renting the right to buy or sell it for a set period of time. But when that expiration date hits, boom, it's gone. Whether it made you rich or wiped you out, the lease is over. Options expire, and that is the game. Now here's the kicker. Just like a car loses value the more you drive it, options lose value the more time passes. That value decay, that's what we call theta. And trust me, theta doesn't care how confident you are, it just keeps ticking. Now let's unpack those three acronyms you've probably seen flying around. ITM stands for in the money, ATM stands for at the money, and OTM stands for out of the money. Simple, right? But here's where the rubber meets the road. Let's say you buy an option contract for $500. Here's the simplest way to think about it. Intrinsic value is the part of your options that actually means something right now. It's like if you bought something for $500 and you could immediately sell part of it for cash. That's the intrinsic value. It's real. It's what your options is already worth based on where the stock price is at the moment. Extrinsic value is everything else. Time, hope, hype, potential, whatever you want to call it. It's the market saying, hey, maybe this option will become more valuable before it expires. But it's not guaranteed. It melts over time. That's where the theta comes in and starts slowly draining your wallet, like a subscription you forgot to cancel. Now, this is why in-the-money options are considered safer. They already have some real value inside, and they're not just hoping something happens. So even if the stock doesn't go in your way by expiration, you don't lose everything. You might lose the extrinsic fluff, but the intrinsic part still holds some ground. Out of the money options, no real intrinsic value. They're all fluff, all hope. So if the time runs out and nothing has changed from the stock price, your options basically a used napkin. Alright, let's take some real world example. Let's talk SPY. Let's say SPY is trading at $589 right now. Now remember, we're talking about call options, which means you're betting that the SPY will go up. Here's the easiest way to tell if a call option is in the money or out of the money. If the strike price is below $589, it's in the money. If it's above $589, it's out of the money. Simple. If you can remember who's higher and who's lower, you're already smarter than half the people trading weekly options. Let's break it down with two quick examples. Example 1, let's say you buy a $580 call option. That's $9 below the current price of $589, which means your options is $9 in the money. It already has some real value in it. Think of it as buying a $580 gift card and SPY is giving you $589 in return. That's a win. Example 2, let's say you buy a 600 call option. That is $11 above the current price of $589, which means your option is $11 out of the money. Right now, it has zero real value. You're just hoping that the SPY will get to 600 or more by expiration. If it doesn't, well, your option is just a fancy piece of paper. So remember, if your strike price is below the stock price, it's in the money. If it's above the stock price, it's out of the money. That's it. That's the whole game in baby talk. Now, here's something more important to understand. In-the-money options cost more than out-of-the-money options. And that's not some random thing. It's because they have some real value inside them. Let's go back to our SPY example. That 580 call is in the money by $9, so it might cost you something like $1,450 to buy. That 600 call, which is out of the money by $11, that might only cost you somewhere around $210 to buy. You're paying more for the in the money option because it has already some baked in value in it. It's like buying something that's already winning. Out of money calls are typically cheaper because they haven't won yet. They're still waiting for the stock to move in your favor. But don't get it twisted. Out of money options are not bad. They're just riskier, but they also comes with more reward if you're right. That $210 out of the money call, if SPY actually does shoot up past $600, that thing could 2x, 5x or even 10x in value. But the odds of the same happening are lower. You're trading cheap price for low probability. It's a bet, but it's a bet with asymmetric upside. So here's the real takeaway. In the money options, relatively more expensive, safer, more stable, but less reward, but more control. Out of the money options are cheaper, riskier, but more explosive, but can go to zero if the move doesn't come. So the smart move, learn when to use each one of them. Out of the money calls aren't dumb, but buying them blindly is. So if you're buying out of the money because you understand the play, the time frame, the volatility, and you're managing the risk, that's sharp, that's trading. But if you're just buying them because they're cheap and you're praying for a miracle, you might just be paying rent to the market makers. Now let's talk puts. And don't worry, we're not gonna rerun the same lecture in reverse. You already get the structure, so here's the flip. Calls, you're betting the market is gonna go higher. Puts, you're betting the market is gonna go down. So if the SPY is trading at $589, a put option becomes in the money when the strike is above $589. Because now you got the right to sell SPY at a higher price than it actually trading for. That's value. If the strike price is below $589, it's out of the money. Because why would anyone want to sell something for less than what it's worth? It doesn't make sense, at least not yet. Same rules apply. In the money puts cost more. They've got real value baked in it. Out of the money puts, they're cheaper, but more risk, more reward, but nothing guaranteed. So let's summarize it this way. If you're buying a call, you want the price to go up. So the strike prices below the current price are winning. If you're buying a put, you want the stock price to go down. So the strike prices above the current price are winning. Once you understand that, you can just glance at a chain and know exactly where you stand. No overthinking. Think of it this way. Calls love being below and puts love being above. It's directional, it's logical, and now it's burned into your memory. And I hope this made in the money and out of the money finally click for you. Then trust me, you're already way ahead than most of the retail traders out there. But if you want to go deeper, strategy, timing, entries, exits, real-time analysis, I do personalized sessions where we can break down your trades, your mindset, and build a real system, the one that fits you. No fluff, just real guidance. Check out the links down below in the description. And if you're not quite ready for the one-on-ones and still want to access the trade breakdowns, market commentary, and behind-the-scenes content, the Patreon got you covered. It's built for traders who are ready to think smarter and not gamble harder. The free videos, they'll give you the map, but if you want to learn how to actually drive, let's connect. Hit a like, drop a comment with any questions. As always, take high probability trades, manage the risk wisely. I'll see you guys in the next one. Bye-bye.